Welcome all to the Unit 2 Life Insurance. In the previous session, we discussed about the principles of insurance in a detailed manner. Principles are important for the governing of actions and the operation of techniques in the field of insurance. So, it guides towards beneficial and fulfilling activities in the insurance industry. Okay students, in this session, we are going to see kinds of life policies or products. Life insurance policies can be divided on the basis of duration of policy, that is time period of the policy, mode of payment of premium, that is monthly, quarterly, half-yearly and annual premium payments. Next, with or without participation in profit, that is the policy holders are entitled or not entitled to share the profits. Then method of payment of claim amounts, etc. So, these are very broad classification of policies in the life insurance industry. Apart from Life Insurance Corporation of India, several other private players are also involved in selling life policies to the general public. The LIC of India has offered varied life policies with different names with distinct features from time to time to suit the needs of the general public. Such policies have been grouped under three major heads. One is individual plans, next groups insurance plans, then pension plans. We will see one by one. In individual plans, to satisfy the requirements of different individuals in different section of society, the insurance companies introduced the schemes. They are whole life scheme, endowment schemes, term assurance plans, plans for needs of children, periodic money back plan, plans for the benefit of handicapped, plan to cover housing loan, joint life plan, plan for high worth individuals, investment plan. Let us discuss all these policies one by one. Now, we will take whole life scheme. As it is clear from the name that these schemes are issued for whole life. The sum assured is payable only on the death of the life assured. The premiums under these schemes are the lowest of all other plans and is payable till death. These are suitable for young people with meager income whose family and growing children need maximum financial security. These schemes have several policies like limited payment whole life policy, limited payment life policy with single premium, convertible whole life policy. Next, endowment schemes. Endowment policies are taken for a specified period in which sum assured is payable on expiry of the specified period or earlier death. Premiums are normally payable throughout the term of the policy or till the prior death of the life assured. These policies provide security to family in case of death and accumulates savings as a source for old age. These schemes have several policies like limited payment endowment policy, Jeevan Mitra plan, Jeevan Mitra triple cover, then term assurance plans. These policies provide coverage for a specified period of time, say 5 or 10 years or so on. Benefit is payable only on death occurring during the term of the policy. Nothing is paid if the life assured dies after the expiry of chosen period. Survives the term of the policy. These schemes have several policies like term assurance, New Bima Kiran. Plans for needs of the children. The LIC has designed certain policies exclusively for the benefit of children. These schemes have several policies like Children's Deferred Plan, Marriage Endowment and Educational Annuity, Komal Jeevan, Jeevan Chaya, Jeevan Kishore. Then period money back plans. The money back plan is useful for those who, besides a desire to save for their own old age and family, feel the need for lump sum benefits at periodic intervals. These schemes have several policies like Jeevan Samriddhi Plan, Jeevan Rekha, Jeevan Bharati. Then plans for the benefit of handicapped. There is now greater awareness about the welfare of this class of handicapped lives, who are generally depend on their parents. Therefore, a need has been felt to provide for these handicapped lives after the parent dies or become old enough to support them. These schemes have several policies like Jeevan Aadhar, Jeevan Vishwas. Then we will see plan to cover housing loan. In order to cover the housing loans taken by the policy holders, the LIC of India has introduced a novel policy entitled Mortgage Redemption. Under this policy, all outstanding housing loans that the policy holder has borrowed at the beginning of the financial year would be payable in the events of his demise. Joint life plans. The LIC of India has introduced a joint life plan entitled Jeevan Sati. Accordingly, a single policy is issued on two lives such as husband and wife. If one or both of them survive on the maturity date, the sum assured along the accumulated bonus will be paid in case either of the couple dies during the policy's term. Two things happen. One, LIC pays to the surviving spouse the full sum assured, and two is the policy continues on the life of the surviving partner without him or her having to pay any further premiums. That is, the life cover on the survivor continues free of cost. Then plans for high worth individuals. The LIC of India has introduced a couple of plans for the benefit of elite section of the people in our country. These schemes have several policies like Jeevan Shri, Jeevan Pramukh. Then investment plan. The LIC of India has designed yet another unique plan entitled Bima Nivesh. It is a simple premium ideal investment plan for those who have no regular income but good periodical income. It is available for terms 5 to 10 years. The guaranteed surrender value is payable after the policy has run for at least 1 year. Term assurance rider is also available by payment of a single premium at the option of the proposer. In case the life assured survives, guaranteed additions will be payable. He will be given the basic sum assured along with compounded guarantee additions. Then group insurance plans. Group insurance plans are meant to provide life insurance protection to group of people. The group may be employer-employee group, labor union group, creditor-debtor group, voluntary group like that teachers, doctors or lawyers. A master policy is issued under a contract between the employer and the insurer, and the policy includes the names of the workers and the insured sum of each worker determined as salary of the employee, job classification, length of the service. Without medical examination, employees between ages of 18 and 60 are covered under this policy, which can be contributory or non-contributory. If it is contributory, both the employer and the employees pay the premium. What are the benefits? On the death while in service, a amount of insurance cover, accumulated savings up to the date of death. On retirement or resignation, accumulated savings up to the date of exit. Contributions are treated as insurance premium and enjoy the benefits under the section of 80C of Income Tax Act. Savings accumulations received are tax free under section of 1010 under Income Tax Act. Contributions and who pays this? The maximum annual contribution that an employee can make to the pension fund and provident fund is restricted by the income tax provisions to 27% of annual salary, that is basic plus DA. The annual contributions are treated as deductible business expenses. Mostly the employer contributes, but if so desired, both the employer and the employee may contribute, in which case the scheme is called contributory pension fund scheme. What are the benefits of retirement? On retirement of a member, the corpus is utilized to provide the benefits. Commuted value, that is equivalent to 1/3 of the corpus, which is tax free. The corpus that remains after providing for the commuted value is taken as the purchase price to provide for pensions as per option set as follows. The report contains the facts about the proposers, the health of the insured, the financial position and other particulars relevant for the contract of insurance. The agent is supposed to give impartial and correct information about the proposer. On the basis of reports, the further action is taken by the insurer to effect the insurance. Then acceptance of proposal. On the basis of the information mentioned in the proposal form, medical report, agent's confidential report and other enquiries from the reference, the proposal is considered by the insurer for acceptance or rejection. The insurer makes an assessment of risk on the basis of available information and reports. On the basis of volume and possibility of risk, premium rate is determined. Proposal is accepted only it seems favorable to the insurance company. After acceptance of proposal, acceptance letter is sent to the insured stating the conditions to be fulfilled by the insured in due course. Premium notice is also dispatched along with the acceptance letter. Then payment of first premium. On the basis of premium notice, the insured deposits the amount of first premium and the insurer becomes the liable from the day on which it is paid. The contract of insurance becomes completed on the payment of first premium. Generally, the first premium is paid along with the proposal form. The policy may lapse on account of non-payment of premium within prescribed time frame. The insurer or the insurance company issues a receipt acknowledging the payment of premium. Then issue of policy. On the payment of first premium, the contract of life insurance comes into existence. The insurance policy is not issued immediately. It is prepared in proper form, duly stamped, signed by authorized official to the insurance company and insurer, and finally issued to the insured. The whole process requires a few days of time. The life insurance policy bears the seal of the corporation and company and contains all details, terms and conditions of life insurance contract. It also contains all details of risk covered and other rules governing the validity of the policy. In this session, we discussed about the types of life insurance policies and procedure of effecting the life insurance policy. Dear students, I like to highlight a point from our discussion is, if a child, a spouse or a parent depends on you and your income, you need life insurance because they are your loved ones. Have a good day.